So what's the secret to trading profitably? Well, the interesting thing is there isn't a huge secret. It's been known for a long time, but you never see it mentioned when you look at the trading market. What you tend to find is people are focused on systems, strategies, tactics. It's a sort of boom, boom, do this, do that, and make money sort of thing. But it's very different. And especially if you come from a gambling or a matched betting background, you won't recognize the characteristics that make a successful trade. Now that sounds silly, because you say, well, of course I know what makes a successful trade. It's going to be something that makes money. But it's not as simple as that when you're trading. So what I'm going to do in this presentation is show you and by demonstrate an example of a successful trading strategy, how it was created, but also explain the detail behind it. So that should give you the basis on which you know how you're going to participate in a market and what your true objective is when trading, because it's not all about strategies and tactics. So anyway, let's have a look and see what we can do here. So the best place to start with a profitable strategy. Well, I say profitable, but let's have a look at what we can see on the screen here, because the issue that you've got is if we actually look at this screen, you can see that I've got positive numbers and I've got negative numbers. This is a trading strategy that we're deploying here. You can see I'm winning £6.75 when I win, and I'm losing £6.14 when I lose. But the problem that you have here is that £6.75 I have yet to take off commission. So of course, if you take commission off of £6.75, it really lowers the value down. And in fact, it lowers it so much that it's just above the amount that we've actually lost. So in this particular strategy, I'm winning roughly about the same as I'm losing. So of course you can look at that and you can sort of say, well, it's a bit like flipping a coin, heads, tails, head, tails, head, tails. It all averages out for time. You're not going to make a penny. However, have a look at the graph that you see behind it. You can see it starts at 0 and it rises and rises and rises, pretty much uninterrupted, a couple of little ups and downs, but generally it's a nice smooth upward curve. And you can see on the axis on the left hand side here that this is an account balance. So I've gone from 0 to about 25,000, and this is a strategy that I deployed this year. So how do you reconcile the fact that I've won or lost about the same amount of money, and yet the strategy has quite clearly worked and produced a very good yield? To understand that, we need to look at it in a little bit more depth, but it shows you that when you have a strategy, you'll have a certain payoff, and when it loses, you'll have a certain negative payoff, effectively. But it's the difference between the two that generates the profit. But it's not just that. That's the way that most people think about trading and about betting and all of these other things. But it's actually a lot more complex than that. So let's have a look and understand exactly what we're talking about here. To do that, we need to throw in some reflection. So if we look at a traditional market, such as gambling, what we're looking at here is, Liverpool are playing well. So the gambler goes up and says, right, I want 100 quid on Liverpool. So the only way that they can make money is, when Liverpool win, if he wins a lot of money there, and when Liverpool don't win, the two will sort of balance themselves out. It's a bit like on that first slide that we looked at. We're sort of saying that, when he places a winning bet, he's going to win more than he loses. Now, traditionally, most gamblers don't even make value judgments. That's a broad sweep. If you're a serious gambler, you'll absolutely make a value judgment. But if you're just a laissez-faire, standard Joe average punter, you'll probably just stick a bet on to win. So you don't really care about the odds that much. You just think, right, we're going to win. It's a binary thing. I'm going to stick a tenner down because England are going to win, because so-and-so is going to score, because this match is going to end up with this particular result, or something like that. But when you describe that pattern of behavior, the best way to summarize it is that you're taking 100% risk. You put your money down, and if you don't win, you lose that money. So the only way you can make money longer term is if you win more when you win. And now that makes perfect sense. So typically, most gamblers tend to love big wins. They love to have those large odds come in. But very often they base their decisions not around getting those large odds, But nonetheless, what we're looking at is a gambler will take 100% risk and they're looking to return more of that back to them. The way that I summarize it typically is a gambler, it loves to put down £10 to win 100. Now, if you're matched betting, or you come from the match betting community, I actually started doing arbitrage betting. Now, I had to abandon it because I couldn't scale it. But 20 years ago when I started on Betfair, I arrived to do arbitrage. If you look at the match betting community now, it's fairly similar, apart from you using offers now rather than outright arbitrage. And when you do that, you're basically looking to create a position that has no risk. So a gambler takes lots of risk. A match better is looking to take none. You could argue that there is a bit of risk there, because one of the reasons I gave up arbitrage was because of bookies welching on odds to me or changing their mind after I placed my bet. And of course, I'd tried to back off the commitment somewhere else. So anyway, that's another story. We'll park that for the moment. But gamblers love to take 100% risk. Match bettors like to take no risk at all. But when you're trading, you're somewhere in between the two. So as the gambler likes to put down £10 to win 100, a trader will put down 100 to win 10, or sometimes maybe even 1,000 to win 10. It's all based around the level of risk that they see in a trade. But you can't eliminate risk when you're actively trading. It's just not possible. It's going to be a balance of several different factors within there. So you can, in essence, say that what a trader likes to do is they love to A, take risk, but also B, their returns are limited to a percentage of stake. So a gambler puts down a 10 and wants to win 100. The trader is the other way around. They'll be putting down 100 to win 10. They're only ever going to return a small percentage return of stake. And generally speaking on trading, any positive value will do. If I think that there's an opportunity for a trade that's almost certainly going to come off, I will use as much money as I possibly can to do that trade. However, as the uncertainty increases, then my stake decreases. I do have a particular type of staking approach, which I can explain in another video if you want me to. But typically that's the way I'm looking at it. I'm looking for any positive return. I'm looking at a percentage of my original stake. And any positive return will do effectively, as long as the risk is balanced and there's a sensible approach to do that. I'm happy to use as much money as I possibly can to get some sort of return out of the market. But let's have a look and understand sort of what I've described there, but in a more visual manner. So if you look on the left here, what you'll see is that we have what we'd refer to as traditional gambling. So, when they win, they're going to win a large amount. When they lose, they're going to lose 100% of their stake. So the only way that they can make money is by having that win portion much bigger than the lose portion. When you're trading, you're going to be putting the same sort of stake into the market. However, your payoff is going to be much, much smaller. So when you're actively trading, you're going to have a small win percentage, but you also need to have a small loss percentage. Where trading goes completely wrong is if you put that massive stake into the market and then you sort of think, well, you know what, actually, I think I can get away with turning this into a bet. No, you can't. You just cannot do that. It does not work that way. You're looking for a small positive percentage or a small negative percentage, and that's the bit that you're trading. You're trading this little bit right here. But you're going to have to risk the same sort of money that you would do with a traditional bet. That's the way that trading works. If we put it into context here, a rather extreme context, we're using £50 here to back, £50 to lay. We've laid at a lower price than we back at. For doing that, our £50 earns us 50p. Whoa, that's going to change the world. But you can see that the return is a very small percentage of the original stake. And then when we hedge it, it shrinks even more. So basically on the £100 that we've put through this market, £50 on the back, £50 on the lay, we've returned 0.25%. It's absolutely tiny. So if you turn this into a bet and you lose, that's effectively going to cost you your entire stake, and that's going to take you 200 trades to get back. So this is why when you look at the visual graphic that we've got here, okay, you're putting a large stake into the market, but you should only ever risk movement on that stake, not the actual stake itself. Otherwise, if you end up losing that £50, it's going to take you a huge amount of trades to get that money back. Just don't do it. Protect your bank. That's the number one thing when you first start trading, is that you must protect that bank. Don't lose it. Don't do anything stupid. Okay, you're not going to make huge amounts, but if you manage your risk, you're not going to lose huge amounts either. It's going to be nicely balanced in between the two. So when you're looking at trading, there's certain things that you need to be aware of. Profit exists in the market. We know where the profit is. We can measure it. We know how it occurs. I can look at a market that's going to take place tomorrow. You give me the characteristics of the market, and I will tell you how much profit is going to be generated within that market. Your mission as a trader, should you choose to accept it, is to get some of that profit at the lowest possible risk. Profit exists across all of the markets. You can measure it. It's there. You can see it. But your role as a trader is not to identify that. It's to be able to get in there and get some of that profit at the lowest risk to your bank. But of course, you can't be right 100% of the time. So you have to accept that you're going to do some trades that are going to work really well at certain moments, and some trades just aren't going to work very well. And as a consequence, it's all about getting that balance right. It's a set of scales. You know, you win this much over here, you lose this much over here. You just need to tip it slightly in your favor. That's the most important thing that you can do, is tip that slightly in your favor. And you'll do it by minimizing the losses that you make, maximizing your entry opportunities. But you'll also do it via a bit of money management as well. And this goes back to the first slide that I showed you. Let's have a look at how we can create a positive expectancy when we're actively trading. If we look on the middle of this slide, you can see that basically if we have a 50% strike rate, we win £10 when we win, and we lose £10 when we win. We've got a 50% strike rate. There's an equal chance of both of those happening. We're going to lose nothing overall. We're not going to gain anything. In fact, we may lose a little bit because we're going to have to pay a commission on our trade. So overall, we would end up with a little net loss on this particular position. So how can we influence that? How can we change things? Well, if we actually look at the options that are available to us, we could cut our loss, because if we trade with a strike rate of 50%, but we can actually make our loss slightly smaller than our win, then you can see overall we end up net up. 50% of the time we're winning £10, 50% of the time we're losing £5, and therefore we end up with a positive expectancy. At the other end of the scale, if you increase your strike rate, then the opposite effect takes place. If you can get your strike rate up to a higher percentage, then in fact what happens is that you can actually afford to lose more than you win, and you end up actually making money. So if we go back to that slide that I first showed you, and that 26 grand or whatever it was, I don't know what the number is off the top of my head. I'd have to look at the spreadsheet. You can see that the profits and the losses are roughly in equal balance. However, you can see that we're progressively making lots of money. So what am I doing there? Well, what's actually happening is that my strike rate on that trade is over 50%. So when I'm winning more than 50% of the time, that's £6. And when I'm losing, that £6 is losing less than 50% of the time. Obviously, if I've got a strike rate of 60% over here, I'm only going to be losing it 40% over here. So you can actually see what begins to happen. We've actually got a few examples on here where the strike rate is 60%. You can see here, 60%, winning £10 60% of the time means if I lose £20 40% of the time, I'll still make a loss. So I need to up my strike rate or lower my loss. Can you see how this is all working together? So when you're actively trading, the best way to understand how to get profitable is to measure effectively what your trade is doing. How much are you winning when you actually win? How much are you losing when you actually lose? And how frequently do you win? So it's a combination of the amount you win, the amount you lose, and your strike rate. They all interact together to deliver a profitable trading strategy. So even if your strike rate is very low, but your potential payoff is high when that comes in, that could be a profitable trading strategy. But you could also have a trading strategy where you get an incredibly high percentage of winners, but when the losses come, they are absolutely brutal and huge. You often see this from people trying to flog you stuff, because the strike rate is high, so it feels like you're winning very, very frequently, but when the losses come, it wipes out all of your potential profits. And also, it feels nice. When you're actually winning at a very, very regular rate, it feels great. You feel like you're doing a good job. However, it may be that actually you're not doing a good job, because your win rate may be high, but your losses will be substantial when they come in. So very often you'll find that some of the best strategies are low strike rate strategies that have a high payoff very often. And, people don't instinctively look there. And when these strategies do occur, they tend to produce outsized payoffs because people just aren't bothering with them. However, up and down that entire scale, I've got strategies that work at varying levels. So I have a backing strategy on racing, where it's looking for a situation that isn't going to occur very frequently, but when it does occur, it produces a massive payoff. So I have loss, a really, really low strike rate, and then boom, big win comes in, and that more than offsets all of the activity on the other side. So yeah, when you're actively looking at a trading market, this is where you would define your strategy. And I can show you this in different markets in different ways, with different payoffs. But each market that you participate in, you're going to have to come up with a model that sort of describes exactly what your objective is. Because if you're losing money, then you can sort of say, well, okay, the way to get around this is to up my strike rate, reduce the number of losses that I've got, or perhaps earn a little bit more money. And you can start to tweak and alter your strategy to push yourself towards profitability. But yeah, when you're trading, it's not really a case of saying I just need to win more than I lose. It's a combination of all of those factors, and depending upon what strategy you decide to put into the market, you'll get a completely different results depending upon what you're attempting to do. So for example, in football, you have very clearly defined parameters, goals, time. That can define where your expectancy is. And in tennis, it's the number of breaks that you get in a match, and the gap between those two breaks defines what likely payoff you're going to get there. If you're scalping, you're going to have totally different metrics from if you're trying to trend trade pre-off on the racing. And if you do something in play, that's going to be different as well. But for each market, there will be a defined sort of trading model that you should adhere to and metrics that you should be working aggressively to improve. But that's how all of my strategies start. I'll very often start at random, start playing around to understand where, what sort of strike rate I'm going to get, what sort of payoff am I likely to have. And then I will actually amend and modify the trading strategy based upon that. And that allows me to get to profitability. But yeah, if you want to actively trade, that's the way that you would get profitable. If you've enjoyed this video, please like and comment below. But also for an extended video and for more content about trading, visit the BetAngel Academy. There's loads of free videos available there, and we're going to add more over the coming months where you can learn to trade properly on Betfair.